here we're going to turn, and typically we jump right into U.S. exports, but here we're just going to do a little bit on Asia first. And the only reason why I'm saying that now, or doing it a little bit differently this time, is because a lot of these Asian exports are going to impact U.S. exports and how that's going to move about the world. So one thing that we wanted to start off with, obviously, please like, share, subscribe. I know you're probably tired of hearing me say that, so I apologize. But just as a reminder, if share it with anybody that you think might care or might be interested in what we're talking about. So when we look at high frequency data for India, you can see that there's that nice little bit of a slowdown in new cases, which is a net positive. Active cases kind of staying at this elevated level. The lockdown index has gone to 81.9%. We're right now about that 82%, even as we speak today, because this is as of May 16th. And it's when you look at the kind of that normalcy side, so the congestion index has continued to get worse. Retail recreation continue to get worse. That's going to remain. And it won't, I shouldn't say it's not going to continue to get worse. It's going to stay at this level as we go forward. And the vaccine dosage has gotten stronger. And now we're actually seeing it starting to weaken a bit. So the vaccine one is going to be that one to look at. How quickly do we get some normalcy into the Indian markets, especially because they're pushing so much product into the global market. So then when we look at some other impacts to what is happening in the world today, we turn to China's tax on dirty fuels. So the tax exemption was a big component for light cycle oil. So China's monthly imports of light cycle oil and China's imports of light cycle oil from South Korea. Here's where, when we look at what has normally happened in general, you can see a lot of this was coming from South Korea. So now you're going to have this decline of these imports, which is going to leave more product in not only just the South Korea, but also in Singapore. So we're going to get this shift of a bit more crude going into China in different ways, but some of this this light cycle crude, the light cycle oil, which again is going to impact or reverberate through the system really in terms of some of this recracking and some of this cracking of different crudes into or changing the feedstock levels. So China will start taxing imports of dirty fuels used to make lower quality products from next month. So it comes into effect June 12th, and they're citing pollution concerns. This also feeds into what we've been talking about with the teapots and Shandong. China does these things when demand is soft, and when they see demand soft, they don't want to say, or they don't want to show that they're naturally going down. They want to be the driver of market imports. So when you look at this is something that is typically going into teapots in terms of what is happening in Shandong. And again, and just another kind of little knife at the independents. And it's just showing that there is a little less demand than expected, but they're trying to, again, kind of put a front on this, that they're the ones creating it, not the market. And again, there will be some. I'm not saying that it's all market or all tariffs. I think that there is a balance of the two, but it's going to be, there is that slowing demand that we've continued to see. We've seen in the numbers. We'll talk again in the Econ show about what is that in general. So imports of products of light cycle oil or low quality fuels that blend into diesel or fuel oil will be the subject of the consumption tax from June 12th. Other products that will incur the levy include mixed aromatics and diluted bitumen, the ministry said, and it will be taxed the same as shipments of naphtha or fuel oil. So again, just a bit more pressure in terms of some of these, some of the abilities for some of these refiners to adjust their feedstock to try to maximize profit. Again, this is going to eat into some of that and slow down some of the imports, which is going to leave more in the world. So this is looking at lockdowns in India. This kind of puts into perspective the declines. When you look at gasoline, gasoline has had a bigger drop on a percentage level. Diesel, we obviously have continued to see the degradation of activity, but it's just going to be a matter of how much. So the second wave has lowered sales of gasoline and diesel by 15 to 20%. but it's really not as bad as the first one, just because the first wave of COVID was a national lockdown. This is a bit more regional, so we're not seeing the breadth of decline. It's a bit more pocketed, but again, still seeing that decline overall. And then the difficult to state when demand will return to normal, and that the hope right now is that it doesn't stay at this level for some time. But one of the things that we're seeing and that we are expecting is that it's going to stay depressed. Not that it's going to keep coming down, and that's what we keep trying to say. It's not going to come down much more. It's just not going to see this massive spike up, because there is this residual, there is this slow vaccine level, and there's going to be this perpetual concern in the market, specifically when we look at India, which is going to keep some of this fairly flat. And then there was a storm that came through, again, impacting demand. These are some of those impacts that keep coming into the Indian markets. Then when we look at China, so the Chinese apparent oil demand was down month over month. So here you can see it was 12.958. We showed this last week where you had that decline overall. And when you look at October, November, December, we're moving in the wrong direction as we come into April. That has since reversed in May. We will come back up in May, just because when you think about the back end of it, when you looked at the front end, the middle of and later of April, you had an increase in maintenance. Then that continued into May. Some of those are coming off, but some of it's remaining. So we will get this backdrop. So China's apparent oil demand, it was up 9.7% year over year. But when we're talking about year over year, we like to look at the month over month, because you did have new refiners coming online. So you'll inherently be higher year over year. Not only did you have COVID, but you also had new refiners coming on that happened to the back half of 2021, which wouldn't be picked up. So again, just something to consider. Total apparent demand of oil processed. So when we look at the China seaborne and pipeline crude imports for May, are estimated to be about that 10.24 million barrels a day, just so far. So when we look at it, it will be down April into May, but it's going to start to increase. And then you'll see that acceleration in June, as we've already started to see an increase of buying from some of the mega refiners that have come on. So we're just going to have to balance out, what does that mean going forward? So what does it mean going forward? Well, here's where we can look at gasoline exports. So gasoline exports were down month over month, but you can see that they're well over the 5-year average. That's going to remain the case, where we're going to continue to see gasoline exports. Gasoline exports will be less, though, month over month. So we're seeing a steady decline of some of these exports on gasoline, especially with the increase the decrease of refinery throughput. But diesel exports still remain near all-time highs. And that's where, even though gasoline is slowing, diesel is actually increasing. So China exported over 600,000 barrels a day of diesel in March and April, the highest volume in at least 4 years, with at least 25% headed to storage. And this is what we're seeing. So it was slightly down month over month, but you can see on a seasonally adjusted level, still, all-time high. And it's based on what we're seeing in the market, it's going to remain elevated in terms of what's going on the diesel side, which when we look at the movements, more light diesel in Singapore, more middle diesel in Singapore, and this is accelerating the amount of product that is moving into the U.S. markets. The biggest question is going to be, what does this new tariff or tax look like in terms of what is the availability of Asian product moving into other markets, which is why I think you're going to see that steady flow of refined product going from Asia into the West Coast. So when we look at this in terms of what has happened with Indian fuel exports, so shrinking local demand pushed fuel exports to a 16-month high. So what we have so far in May, we have about 1.5 million barrels a day coming into the market. You can see a lot of it being diesel and gasoline, which is why we continue to see a huge slug and a huge movement coming into the Atlantic Basin, into Singapore, because we're seeing a lot more product just coming into the market, especially from the Asian side, which is why, if you remember last week and the week before, we were explaining kind of that this backlog that is just keeping things capped and pushing things overall. So outflows of gasoline in the first half of May soared 85% from the same period last month, while diesel exports surged 65%, according to Vortexa. Overall, so-called clean oil, clean products, including gasoline, naphtha, and diesel, climbed 1.5 million barrels a day. If the momentum continues through the rest of the month, May exports would be the highest seen since January of 2020. And just based on what we're seeing, our prediction is it is going to continue, which is why we think that this, anywhere between 1.5 and 1.7 million barrels a day of exports is going to remain in the market in general. So then when we look at U.S. refiner exports, most diesel in 13 months, to run down the domestic inventories, because remember, we were saying inventories were significantly higher than they should be. And that's been one of the key components where the government always issues quotas for exports. They're trying to now utilize these quotas to try to balance some of these percentages. So China's overseas diesel shipments in April rose to the highest level in 13 months. Daily shipments of the fuel were 676,370 barrels a day, the most since March of 2020. So just think about what was March for China, and you get an idea of just how excessive these exports were. When we look at China has surplus supplies after the nation produced 13.16 million metric tons of diesel in March, the most since October. And that's why when we saw this big pull through, they just didn't have the capacity, so they had to export more. And we're seeing that slowdown on the industrial side, which again is putting just that headwind on what is happening within the Chinese markets. And this has led to private processors selling cheaper diesel into the wholesale and retail markets to trim inventories, taking share from state refiners. Again, not something China likes or wants, which is why we're starting to see some of these pressure points on the independents. Stockpiles held by independents province were at about 24% of capacity in April, the lowest, but again, it's still elevated on the seasonally adjusted level, which we'll talk about at the end. Meanwhile, China exported 410,000 barrels a day of gasoline last month, the least since December. Overall, overseas fuel shipments may fall further in the second quarter after the government decided to tax some products used for blending. So this is where we're going to have to look at what is some of the capacity. Now, when you also take away some of these blending components, you're going to increase the price of the product in China. So there was already a headwind for demand. As prices go up, this will only increase those headwinds when we consider what is the demand profile going to look like in China. Indian refined product demand, just kind of putting it into perspective, month over month, diesel was down 20 so far. Diesel was down almost 21%, gasoline down 20%. These are the things that are going to continue to weigh as we look at the local level, which is why when we turn to India's annual crude imports fall to the lowest in 6 years, and this is for 2020 into 2021. India is already looking problematic. May imports at 16.34 million tons, or about 3.85 million barrels per day, which would be down from April's 4 million and 4.32 million in March. So you're continuing to see a decline in Indian imports, which is just leaving more in the world. In the market in general. And that's why as we see this product coming through, that kind of gets us now, where are we in the U.S.? So U.S. gasoline exports down 161,000 barrels a day. Distillate was down 49,000 barrels a day. Those are the headwinds that we continue to see, especially on the distillate side. So gasoline is 429,000 over the 5-year average. We will see some of that moving a bit more into the Latin American markets. But then as we see more again, deliveries of Saudi Arabian gasoline, European gasoline. That's again going to keep some of that capped. And then distillate, which we normally send a lot of that into Europe, they actually have a big increase. Europe is importing a lot more from East Asia. So European arrivals of clean petroleum product from East Asia are set to rise. We now have a fourth VLCC filled with product that is going to show up in Europe, again, putting those headwinds on the distillate side. Propane was down 163,000 barrels a day, still elevated, up 355,000 against the 5-year, or 1.3 million per day for the week. Again, that it's going to be kind of this balancing act. Then total crude. So crude went from, it was at 3.3 million barrels a day. Again, this timing side, and you also had refiners that in PADD 3 that are trying to manage storage. So storage is still above the 5-year, still growing. You have the headwinds of Colonial. Now they're trying to try to balance that. You did have more purchases coming from Europe. That is sending more into Europe, but that just gets us, instead of it staying at 1.8, which is kind of that base level, that keeps us at about 2.6 to 2.8, which is, I think, that comfortable number. So we will see oil exports decline, and we'll see a little bit of an increase in some of the products. Looking at gasoline, you can see that there's typically this big drop. We didn't have it on, obviously, because there's a lot of gasoline left in PADD 3. So they're trying to manage gasoline exports as well, gasoline storage. This is going to keep some of these exports elevated versus where they typically are this time of year. It'll still trend down, but again, still remain on a seasonally adjusted high. Distillate, we were expecting to move closer to the 9-year average, and kind of here we are. The trend is going to be, flat to slightly down at this point, just kind of moving along this 5-year move. Not too much, to surprise up or down at this point. Then when we look at crude exports, back to that top of the cloud, as you can see, we're still above some of these peaks, but we're still going to remain elevated in general, just coming just below that 3 million as we go through. Because as we said last week, we expected a big bounce. We expected that bounce to be closer to 2.8, came in at 3. Now we'll start to see that track, much closer to about 2.6 next week, and then stay within that range on an average basis, as we see LPG exports remaining elevated overall, down from the previous week, down from the 2021 high, but still above the seasonally adjusted high levels, and that will stay above the general moves overall. In terms of just staying above that 5-year average, staying at the top of the cloud in general, and if not setting new seasonally adjusted highs for LPG, still staying at that high level. But then when we turn to ARA crude, we saw a nice little draw and you could see it's counter seasonal, which is nice. And this is where we do have some refiners turning back on, pulling down some of those stocks. We also had an increase in floating storage, so there is that timing delay. So this is something where it'll still be at we just think it's going to follow the 5-year average, and it's going to be coming from storage into offshore storage into onshore storage, which is going to be a build, but again, along that 5-year average, which is nice to see a little bit of normalcy within Europe. Now, when we turn to the physical market, one of the one that we want to talk about the most right now is Nigeria. So Nigeria had a big drop in May because there were 2 deferrals that happened in April that deferred from April into May. Now we're getting more deferrals from May into June, and that's why you're getting that shift. So we actually went down in what is the loading schedule for May, and it has now increased significantly in June. And it's not because, and remember, there is more crude already in the market in May because of the OPEC deal, because of the Saudi additional cuts coming back. But not only is that an issue, but now you have more in June, and now Nigeria is already starting to say is going to post their levels for July. The talk is that there's going to be more deferrals over into July. Angola try to respond. You see them actually coming down June into July. There's a potential to see one or two cargoes deferred out of April into July. So we could actually see some of this move over. And I would say that they're starting to prepare for that just based on what we're seeing. Now, when we look at the general backdrop, you can see on ESPO, so Russia's ESPO for July 9th through 16th and July 12th through 19th and July 16th through 23rd. So again, already back of July, the loadings are at about $3.20 to $3.55 on a premium to Dubai benchmark, which is a net positive. The benefit for ESPO is the Dubai benchmark has really weakened. So, I mean, not to say that there isn't strength in ESPO, because there is, but you're getting a little bit of strength as the Dubai weakens, so that differential looks a lot better. On the other side, 3 euro cargoes were sold, and they were at a slight discount when we look at the Surgut and what they sold in general. The pace of CPC blend is picked up. There's still a little bit of a bid in the CPC. So at the end of April, it was trading at -$3. It's now pretty firmly at -220, -230. So a little bit of premium, not a huge amount. So that's some of the positives. The other pressure is really in Nigeria. So Nigeria has an elevated amount of volumes that are unsold. So right now, at least 25 cargoes for June are unsold at this point, or almost half of next month's or June's planned loadings. So, and this is going to put that pressure on July. And the same thing has happened in Angola, where Angola is essentially stalled. And that's a bigger problem for what's happening in China. Now, when you look at Japan has actually been starting to pick up some new sales, which is a nice positive to see, where Congo has seen a similar pressure point. Now, Senegal has sold a cargo. It's at a lower price point because the offer price was cut to 45 cents off of what was initially 20 cents. So again, a little bit of that discount to try to move these cargoes through. All the while, cargoes are starting to get a little bit of a discount in the North Sea, in Europe. We're going from $1 premium to 95 cents, going from $1.05 to about 90 cents. And these are some of those additional pressure points that we're seeing. And then we had WTI Midland for July 5th to 9th, delivered at July dated -10 cents. So we're starting to see, again, some of those movements into Europe from the US at a slight discount. But when we look at the aggregate level, there's some good spots, some weak spots. West Africa and the Middle East remain the biggest overhang when we're looking at the physical market, let alone just the amount of product, refined product that's in the market. But that's why we think there's going to be that continuous slowdown in physical buying, because they're going to try to work through some of that excess refined product before they turn to buying a bit more crude. You're starting to see more in July, but again, July still, and now remember, this is for loading in July, which means that this doesn't become product or used product until October. So we're already through the summer demand push, which is just something that we always like to point out. So then when we look at what has happened in Fujairah, light distillates had a big build, which is what we've been talking about coming. That's one that we think is going to remain elevated. Same with middle distillates. So Fujairah reported an increase of 1.2 million barrels in storage, which is up 5.4% week on week. Light distillates rose a little over 1 million barrels, which is a build of 20% to 6.12. And east of Suez gasoline market was finding some support with from an expectation of lower gasoline exports from China. So there is that expectation, which we showed, but India is essentially offsetting that right now. So that's why we think some of this is going to be a bit difficult. And there will be that consumption tax on imports of mixed aromatics for June 12th. And aromatics is key for octane. So this is going to be an interesting, what is going to happen with pi gas. And that's why when you look at trying to protect Chinese margins on the refining side, it's really on the aromatic and octane side, which is where we're seeing some of those big pivots. Now, the stock of middle distillates fell 350,000 barrels to 3.7, or down 8%, 8.5%, 8.6%. The middle distillate market was also reacting to the news on the consumption on the China side. Industry sources said the announcement on consumption tax on imported light cycle oil in China will translate to leaner outflows from the country, as local refiners are likely to cut exports in the months to come to fulfill the local requirements. Again, these shifts and moves. Stocks of heavy resid rose 4.1% or 535,000 barrels. In Fujairah, activity in the port was starting to pick up as we see the end of the Muslim holiday of Eid, and things start to get back to some normalcy in the region. Now, when we look at crude oil on the water, we're essentially steady state. We thought we were going to get a little bit movement to the upside, but the biggest drop was really in transit. We saw that there was transit. We were expecting a bit more crude to be in motion. Instead, we essentially stayed flat. This is where we start to see a little bit of an increase in general. Crude oil floating storage, small decline, but you can see that we're still at taking out obviously 2020. We're still at very elevated levels. That is that is still higher than 2016, which, if you remember, that was where we had all that OPEC fighting. So again, this is why we still remain in a glutted market. Then when we turn over into what is happening in Europe, you had some declines pretty much across the board. And just to reiterate, the new VLCC that was added is the VLCC Dickens with diesel type fuel, which will arrive in Rotterdam in early June, according to Kepler. So again, kind of backfilling some of this gas oil and diesel. And that's the tanker has 263,000 tons of gas, oil, and diesel. And it should be there by June 5th. But when you look at the gas oil market, there is room for it, especially when we go back and look over the last 13 years or so. Gasoline is the one that we expected to see draw down faster, and we're just not seeing that. But as we get some new loadings coming into the U.S., more driving within Europe, that'll help support some of that activity. And then fuel oil continues to get recracked. So we did get another nice drawdown in fuel oil. But again, that's also becoming product, which is weighing on some of the drawdowns in product and keeping some of the imports of crude fairly capped at this point in time, specifically into Europe. Then this is what we're looking at when we talk about gasoline. So gasoline typically on a seasonal level draws down now. The rate of change is essentially spot on to where it was, where it normally is. But you can see that it's obviously happening at a very elevated level. So we'd like to see that accelerate a bit. But as refiners start to come back and they're going to be targeting some of this gasoline market, especially the export world, we think that you're going to have this remain elevated against seasonal norms. And this is where we look at fuel oil. The drop has accelerated. And again, this is going to be married with just this going back into the refiner in order to get cracked into different product. Then when we look at Singapore, you can see that net, we had a small build of about 100,000 barrels. And this is kind of what we were saying, where on an aggregate level, we just expected this to go sideways. There's more leaving Singapore, getting sold into the Atlantic Basin, into Europe, in the U.S., but then there's more backfilling it, which is why it's just going to be timing. But for the most part, it'll be flat across the board. The bigger concern is obviously middle distillate. We're coming back to seasonally adjusted all-time highs. Excuse me, not obviously 2021 highs, but getting back to these elevated levels, which just when we look at what's coming out of China, what's coming out of India, is likely to show up here. And here's where we're starting to see this bounce on the light distillate side. Just based on the additional gasoline being exported, we expect to see the light distillate trend higher in general. The Brent time spread continued to move down. When we look at just the near term, you can see it's now at 12 cents. We've really reversed down from from some of these peaks. Again, when we look at front month, starting to see some of these headwinds. And then when we look at the time spreads, December to December, they're starting to come off of highs. You're starting to get some of this pressure to the downside. Again, it's just front month reactions. We continue to think that the front month is still elevated based on where the demand really lies. And that's why if you think that there's going to be a really strong summer, you really shouldn't be buying front month, but something closer to December. So that's why you've seen some of these bids, because I'm not the only one that says that or sees it, but these are going to be ones to watch to see, is there going to be some additional softness as we come into the end of the month. Now, this is factoring in a lot of different things right now, but we had a big shakeout in refining margins, specifically in Singapore. This is the reverberating factor from more exports from China, more exports from India, but also just the elevated level of some of the crude differentials, because the discounts in crude and some support at the back end supports margins, and you're just getting with some of the tightness in some of the grades coming into Singapore, some of the headwinds shipping some of that excess semi-refined product into China is coming in, and that's where you're starting to see a lot of this pressure, especially essentially across the board. We're now below zero. When we look at this Dubai hydrocracking refinery margins, you can see again pushing the bottom of that cloud. We think it'll continue to come under pressure, especially as we get additional slowdowns, not just in India, but other parts of Asia. Same thing with Urals. So Urals have the margins have started to bounce a little bit, but just based on some of the headwinds in general, and some of the increases in Ural pricing, that's going to put some of those headwinds on refinery, on European throughput, and just what does that margin look like? Libya has been, there were some Libyan cargoes that just got sold. That just means that there's going to be more cargoes available in the Mediterranean, which has pushed some of these margins down, because you'd rather run Libya instead of medium, Mediterranean Urals. And these are the different flashpoints where some things are getting a little bit better in the physical market. Some things are remaining or getting a bit worse. And it's just going to be a matter of where are you looking at when you're talking about it, which is why when we look at Chinese super tankers, you can see we're back to the 5-year average. And just based on some of the flows that we've seen cross, we should see this continue to trend up. We're not saying it's going to be a huge surge above the 5-year average, but the trend will be higher. And this is the more concerning side, is because when you look at the refinery run rates for the Shandong independents, they've increased a little bit, but still kind of at this high 60s level. And then when you look at the state-run refineries, they still remain fairly low. We should be in some locations over 80% right now, and we're really not. And the problem, and again, it speaks to some of these changes, some of the shifts, and the movement of independent refineries into the internal market versus the export market, keeping some of these pressures in general that remain, I think, a bigger problem on the longer term, if you will, on demand. Which is why when we look at Asian floating storage, we expect this to continue to trend higher. And remain elevated. You could see it's clearly above any other year outside. Obviously, 2020 was an interesting time, but I think we take out the 2021 highs as we continue to remain at an elevated level on Asian storage. And that's also going to be at that timing, because we do have Japan buying a bit more. We do have some of these shifts. So that's going to bring more cargoes into the water. It's just not only just COVID increases in other areas, smaller areas, but just Asia in general is going to be, struggling. North Sea had that bounce, which we were expecting. We think it's going to bounce a little bit higher, especially with some of the pressures on differentials, because some of them have weakened. And then you do have work being done in June, which is going to put, keep some of this low, just because there's going to be less cargoes available. But again, when we look at West Africa, so we were expecting it to move higher, because we got this big surge in deferrals that essentially delayed some of these cargoes coming onto the water. So this looks better than it actually is I guess the long and short of it, because you do have some of these shortfalls, you do have some of the deferrals. But again, this is something that's still within the 5-year. It's just, we think that this is just based on the problems in West Africa, it's going to trend higher. And the reason why is when we look at the Middle East is continuing to trend up, as we were saying it will. That's where we see some of this competition, especially as we have more cargoes available. given the reduction in the production cuts from the OPEC agreement. Europe is one, again, the timing in terms of when they're showing up. This is where, when we look at European floating storage, will continue to track higher, but still remain well off the 5-year average. And now some people have made a big deal about Chinese drawdowns, which you can see that on yes, against 2021, it's below highs, but on a seasonally adjusted level, we're still at all-time highs in general, which is why we continue to see the problems in China. And then when we look at fuel oil, it's back. It's still at the highs of 2021, still at seasonally adjusted highs across the 5-year average. But this is where it's going to be a pivot of, well, how is this? Is it going to get recracked? Is it going to get exported? Because these new consumption tariffs will start to weigh on how some of these products are moving about, which is going to adjust flows in general, which we're going to go through in our insights this week. So I know we covered a lot. As we always try to do, this one ran a little bit long, so I apologize. If you have any questions, I'd love to hear your thoughts, opinions, things that you might want us to hear or talk more or less about. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.